Hey everybody, Dave Lewis from High Impact CPA here. Hey, we are going to dive into a series on the One Big Beautiful Bill and all of the changes that it's brought, and it's a lot of them. So the way I'm going to structure these videos is we're going to take it one topic at a time, so it's a little bit more digestible. So we're going to go through some of the more simple stuff first that deals with a lot of individuals, a lot of businesses, and we're slowly toward the end of the series, we're going to get into some of the more complex and interesting planning stuff. But regardless, we are going to walk through this One Big Beautiful Bill together, go over what the tax changes are and how they may affect you, and give you some planning opportunities along the way. So the first one I want to start with is the standard deduction, changes to the standard deduction. So when you file your tax return, you get to choose either the standard deduction, which is a pegged amount based on whatever is in the code during that given year, adjusted for inflation, or you get to pick itemized deductions. So these are things like some of your charitable contributions, medical bills, state and local taxes. You get to pick whichever is larger. So, which means when you're looking for your tax professional, make sure they're running the scenario analysis for both. But what did the One Big Beautiful do for the standard deduction? No. What we have here, we've got an increase in the standard deduction amount. So every year they're going to rise with inflation. But the big thing this did is in 2017, the Tax Cut and Jobs Act essentially doubled the standard deduction for everyone across the board and got rid of personal exemptions. So it used to be you'd have a smaller standard deduction, and then for you and each one of your dependents on your tax return, you would get an exemption. Well, they did away with exemptions and they doubled the standard deduction. And what the Big Beautiful Bill has done is now made that provision permanent. So until they change the law again, you can expect these amounts down here to rise with inflation year over year. So exemptions are gone permanently. The additional standard deduction for people over age 65 or who are legally blind has stayed the same. But the most exciting part, and if you are over 65, this is the part you need to listen up to the most closely. Excuse my grammar. So we now have a bonus $6,000 standard deduction amount for taxpayers that are over age 65 that is subject to some income limits, and we'll go over those below. So if you are single or married filing separately, your standard deduction is $15,750. So as you're figuring out your adjusted gross income or your taxable income, you get to take this away to derive your taxable income. That changes if you're head of household. That's been up to $23,625. The reason it's different from single versus head of household is it kind of creates parity between getting rid of those exemptions and the fact that you have to take care of dependents. So you've lost the dependent exemptions, but they've given you a higher standard deduction if you qualify for head of household status. Now, if you're married filing jointly or you're a qualified surviving spouse, you get $31,500, which is just $15,750 doubled. So these are going to get adjusted every year for inflation going forward, as they have for many, many years. But just know these are now permanent. It's a permanent provision. Now, there's also an additional standard deduction if you are over age 65 or legally blind. So if you are single or head of household, that amount is $2,000. So this adds on to these amounts above. And if you're married filing jointly, married filing separately, or a surviving spouse, that amount is $1,600. Married or surviving spouse, $1,600. Okay, let's jump into the really exciting stuff. Let's talk about the new deduction for seniors. So this bonus deduction starting at $6,000 and phasing out depending on your income limit. Now, the trick with this one is this is a temporary provision. So you will only have it available unless they extend it again from 2025 through 2028. So this gives us a lot of planning opportunities within those windows. To qualify for it, each person qualifying must have a valid Social Security number. You cannot file married filing separately. If you file that way, this is gone. It's out the window. Well, let's talk about the income phase-outs. So if you're single, head of household, this additional deduction phases out, meaning it slowly gets reduced as you go between these two income levels. So for single head of household, 75,000, capping out 175,000. For married filing jointly, surviving spouse, it's 150,000 to 250,000. So that means if your income goes above this level, depending on your filing status, you don't get any of the $6,000 amount. If it falls between, you get a portion of it. And we'll go through an example just to kind of show you what that does. But essentially, every dollar you go above that threshold, you're going to lose 6 cents of that deduction. So let's run through an example really quick. So let's say I'm a couple, I'm a senior couple, I'm married filing jointly. Both of us are over age 65, and I have a modified adjusted gross income of $140,000. What's modified adjusted gross income? Well, it's a little beyond the scope of this video. There's some circular logic to it. For the purposes of this example, we are going to say your modified adjusted gross income is equivalent to your adjusted gross income. So you'll see that on your tax return. If you look at your prior year tax return, there's a line for adjusted gross income. So, married filing jointly, I get the standard deduction of $31,500. That is a given. I also get the additional deduction for being over 65 for each taxpayer. So an additional $3,200. Now, since my income up here is below this $150,000 phase-out amount, I get the full amount of that $6,000 additional deduction for seniors. So it's per taxpayer. So that adds up to $12,000. And all of these stack on each other. And it does not matter whether you itemize or not. So for someone in this income level, their standard deduction is going to be $46,700 at a max. So that's quite the shift. It's a nice bonus for the next 3 years for people to plan and maybe lower their qualified minimum distribution, charitable minimum distributions, look at tax loss harvesting, things like that to get below that threshold and claim that maximum deduction. For example, let me show you what happens if we go above the phase-out threshold. You'll see, let's say we make $165,000 as our modified adjusted gross income. Now you see that the deduction amount start to decrease. It slowly goes down until you hit the threshold, $250,000. You get none of it. So, the big planning opportunity is to say, hey, we want to keep our income below that level as much as possible to derive the maximum amount of deduction. So again, just to go over the quick points, that $6,000 additional deduction, it's only available for the next 3 years. Married filing separately, you don't get it. And there's the phase-out amount, depending on your income. So what can we plan for with this? Well, you want to be looking at whether it's more advantageous to claim the standard deduction or the itemized deduction. This is a good place to add up all of your medical bills and all of your state and local taxes, your charitable contributions, and some other miscellaneous items, and see if it's going to beat that threshold for the standard deduction. If it is, you always want to take what's most advantageous. If it's not, or if you're on the cusp, you may want to consider things like charitable donation bunching. So rather than spreading charitable donations over multiple years, save them and do it all in 1 year, maybe after the phase-out in 2028 if they don't extend it. So you can make one big donation and then itemize that year when this provision runs out and save a lot more in taxes. Same thing with your qualified charitable distributions. If you're required to make required minimum distributions out of a tax-deferred account, say like a traditional IRA, now might be the time to talk with your advisor and see, hey, if we do a qualified charitable distribution, will that put us below the threshold to get this bigger deduction in the end and reduce our taxable income? There's also some awesome above-the-line charitable contribution deductions, meaning it doesn't have to be itemized. So there's some additional planning opportunities there. And the other biggest thing is you're going to want to reevaluate what kind of withholdings you're taking out during the year or what kind of estimated taxes that you are paying. Reason being, with this bigger deduction, you may be giving Uncle Sam an interest-free loan throughout the year. Yeah, you might get back a big refund at the end of the year, but now we've missed an opportunity to invest additional amounts, take advantage of compound interest and capital gains, all of that. So take a look at your withholdings, do some modeling with this, and work with your tax professional to see what is most advantageous for you. If you need help understanding this, if you want someone to look at your particular situation and go, hey, let's evaluate what is the best option for you, feel free to reach out to my team at High Impact CPA. We'd love to help you out. We do a free 30-minute consultation with you to look at what's going on now, what the ideal state is as far as tax savings goes, and we will get a plan in place for you to save the most amount legally possible. All right, that's it for the standard deduction. We are going to look at the no tax on tips deduction next. So stay tuned for that. Thanks so much, everybody. Have a great day. Like and subscribe down below if you want to get more content. That certainly helps our channel out and helps us help more people out there. Okay. Have a great night. Thanks.